India's inclusion into global bond indices via the fully accessible route has exposed a massive liquidity pool for non-resident investors. Institutional capital is flowing into Indian sovereign debt at scale. This terminal interface displays the GBIEN Info Index, that is the Bloomberg ticker for the JP Morgan India Government Fully Accessible Route (FAR) Bonds Index. It serves as the exact unhedged benchmark that portfolio managers are graded against. Effectively, tracking an emerging market debt index requires resolving a structural tension. Purchasing the underlying sovereign bonds is only the beginning of the trade. The first constraint is mathematical. Portfolio managers must parse strict index calculation methodologies. They need a precise accounting of clean pricing versus dirty pricing and exact day count conventions for accrued interest. The second constraint is operational. The physical execution layer of the Indian market is currently undergoing significant changes, driven by evolving local capital controls and the tax framework introduced in the 2026 Union Budget. Foreign portfolio investors must deconstruct the JP Morgan formulas from first principles, while actively navigating the frictional realities of new SEBI updates and tax codes. An FPI's realized return is ultimately a function of two variables: minimizing tracking error within the theoretical mathematical model, while aggressively optimizing the physical operational plumbing. To model the return, we have to isolate the foundational unit of the index. Not every Indian government bond qualifies for inclusion. The JP Morgan inclusion parameters are rigid. A bond must have an issue size of at least $1 billion equivalent. It must be strictly denominated in Indian rupees, and it requires greater than 2.5 years of remaining maturity on the index rebalance date. Floating rate bonds, treasury bills, and any instruments with callable or puttable features are strictly excluded from the pool. This equation represents the daily total return calculation. It is the primary metric JP Morgan uses to quantify bond performance over time. The numerator relies on two inputs for the current market day. P is the local market closing clean price. A is the accrued interest calculated up to but excluding the value date. The denominator applies those exact same variables, clean price and accrued interest, but pulls them from the previous market day, dictated by the local Indian holiday calendar. Accrued interest is calculated sequentially by settlement day. Every week, 7 days of interest are strictly accrued, including weekends. This timeline charts that continuous upward build of accrued interest. It rises steadily until it hits a highly specific mechanical trigger, known as the coupon value date. On the exact coupon value date, the accrued interest for a specific bond drops entirely from the calculation. It resets mathematically to zero. This trigger dictates the ex-dividend penalty. If a portfolio manager buys a bond after the ex-dividend date, they will not receive the bond's subsequent coupon payment. To compensate the buyer for that missing cash flow, the purchase price is forced below the clean market price. In the index methodology, this creates a state of negative accrued interest. The index models these accruals flawlessly, in a frictionless environment. Portfolio managers are forced into a constant race to perfectly replicate these theoretical price movements with physical trades. The daily return calculation feeds into the broader performance benchmark governing the portfolio, yield to maturity. This is the two-step iterative equation used by the JP Morgan Index. It determines yield by calculating the discount rate at which the present value of all future cash flows equals the clean price plus accrued interest. The methodology isolates the discount rate variable, small r. Because settlement days and cash flow timelines vary, the index algorithm must solve for this variable iteratively. The mathematics assume perfect market efficiency. The physical execution relies on rigid operational mechanics. The JP Morgan indices are modeled as always fully invested. When a coupon is paid out, the index immediately assumes those funds are reinvested straight back into the local market. Portfolio weight adjustments are executed on a strict schedule. Rebalancing happens exclusively on the last weekday of each month. The benchmark calculates all of this in a tax-free, transaction cost-free vacuum. An FPI tracking the index must fund those instantaneous reinvestments and strict monthly rebalances using actual capital. Theoretical yield models fail if the underlying market plumbing restricts capital flow. Physical settlement in India carries unique liquidity constraints. Historically, FPIs faced a severe liquidity bottleneck. They were forced to transact on a strict gross delivery basis. Intraday square-offs were explicitly forbidden. On index rebalancing days, this created heavy operational drag. To buy incoming index bonds, FPIs had to secure massive short-term funding to cover the purchase upfront, because they could not use capital from their outbound sell orders until those trades fully cleared. In January 2026, the Securities and Exchange Board of India released a consultation proposing a structural change to market plumbing, permitting the netting of funds in the cash market. This split screen compares the intraday capital requirements of both models. Under gross delivery on the left, large isolated blocks of capital are trapped in transit. The FPI has to source external intraday funding entirely separate from their sales proceeds. Under the netting proposal on the right, the proceeds of a sale flow directly into an offset for a purchase obligation. The FPI only has to fund the net difference. Permitting net settlement directly eases liquidity pressures. It eliminates the need for expensive short-term gap funding, allowing FPIs to match the JP Morgan index rebalances with far higher capital efficiency. The settlement plumbing is streamlining, but the direct cost of executing those trades shifted under the 2026 union budget. The finance bill eliminated the 18% goods and services tax on brokerage and intermediary services provided to FPIs. By treating these as exports, the government significantly lowered direct cash market transaction costs. That cash market benefit is offset by rising friction in the derivatives market, which FPIs heavily rely on to hedge their index exposure. This chart details the securities transaction tax increases effective April 2026. The levy on futures more than doubles, from 0.02% to 0.05%. Taxes on options premiums jump from 0.1% to 0.15%. The tax rate levied on the actual exercise of those options also scales up, rising to 0.15%. FPI capital gains rates remain steady, but the treatment of corporate actions is changing. Share buybacks are now taxed directly as capital gains rather than deemed dividends, requiring minor adjustments to broad portfolio tax models. The 2026 budget establishes a distinct operational dynamic. Executing the underlying bonds in the direct cash market is cheaper, but hedging that portfolio against tracking error is distinctly more expensive. Securing yield requires balancing pristine mathematical theory against physical market friction. We track theoretical yield to maturity through real-world filters to calculate realized net return. The yield passes smoothly through SEBI netting and the 0% GST filter, but when hedging, it hits the restrictive securities transaction tax on derivatives, immediately shaving off a portion. In a strictly indexed environment, an FPI's competitive edge is not derived from bond selection. The JP Morgan FAR Index already dictates the investable universe. Alpha is generated in the execution algorithms. Outperforming competitors requires precisely timing accrued interest resets while ruthlessly optimizing the new net settlement margins. Capturing yield in India in 2026 requires treating the regulatory settlement plumbing and the JP Morgan Index mathematics as a single unified equation.